As you go about planning for your 30 June 2019 reporting season, we've got some key things for you to think about. No doubt you're busy implementing the new Revenue and Financial Instruments Standard. But remember, these new standards also have enhanced disclosure requirements, which really cannot be left to the last minute. And even if the impact on your numbers is not significant, don't underestimate the amount of time that it will take to rewrite accounting policies and to provide these new qualitative and quantitative disclosures. If you're a year-end entity, then there are some narrow scope amendments and new interpretations that you'll also have to think about. One in particular is the interpretation 22. So if you do receive or pay foreign currency amounts in advance of receiving products or services or providing products and services, have a look at this interpretation. If you're a half-year reporter, then you're busy implementing the new LISA standard for the first time. You've also got some narrow scope amendments that you should be thinking about. If you have investments in loss-making equity accounted investments or equity accounted joint ventures, where you've provided some long-term funding to them, then you want to have a look at the amendments to the Financial Instruments and Equity Accounting Standard, which provides guidance on how you go about doing your impairment calculation on the loan and how you do your equity accounting. As we've been working with companies on implementing these new revenue and financial instruments standard, there have been some recurring issues that we've been working with them on. The first one to note would be whether revenue contract costs should be expensed or capitalized. The standard refers to these types of costs as fulfillment costs. And if you do end up capitalizing them, then when you do amortize them, where do you present them in the P&L, and should it impact EBITDA? The other recurring issue relates to the new financial instrument standard and when you're doing your expected credit loss calculation on trade receivables. If you have a simple portfolio of trade receivables which share credit risk characteristics, then have a think about whether the single loss rate calculation approach, which is definitely the more simpler approach, would be of benefit to you. If you are interested in these areas, then our the hot topic session of our recent webinar on reporting for 30 June 2019 issues will be of interest to you. ASIC also is continuing with its financial reporting surveillance program, and their areas of focus when they're reviewing your financial statements are not expected to change significantly. However, we're of the view that given all of the various inquiries that have been held recently and the media attention around how regulators are not tough enough on big business, that we do expect that ASIC will be taking more of a combative approach to their surveillance activities. And lastly, if you are impacted by the legislative requirements to lodge general purpose financial statements with the ATO, then you'll be interested to know that the ATO has recently issued updated guidance which provides some clarity around the basis of preparation for different types of small proprietary companies and better defines what they mean by commercially accepted accounting principles. So those are our key considerations for 30 June. If you do need more detail, then have a look at our webinar on this topic, and good luck. Thank you.